Hello, my name is Ryan Schneck. I'm the Director of Client Portfolio Strategies within SEI's Investment Management Unit. I'd like to take a few minutes to describe the main principles of our approach to investment management, with a focus on the most fundamental aspect, strategic asset allocation. Strategic asset allocation sets the foundation for achieving your portfolio goals and objectives, and diversification is the cornerstone of creating efficient, optimal portfolios. As we all know too well, investing comes with uncertainty, and that makes diversification and discipline even more important. Active management is a great complement to strategic asset allocation. The investment professionals at SEI actively manage our clients' portfolios with both a top-down asset allocation point of view as well as a bottom-up security selection perspective, all the while carefully controlling the level of active management to avoid straying too far from the policy portfolio. We've been in the investment management business for more than 25 years, and we have a track record of finding skilled and specialized institutional asset managers. We understand that managers in the top quartile one year can often find themselves in the bottom quartile the following year, and vice versa. So instead of making manager selection decisions based on performance, we focus on identifying a manager's competitive advantage and conducting comprehensive research about the market inefficiencies they're capitalizing on. And in the end, we view the entire investment process through a risk lens across all sources of risk. We apply rigorous risk management practices across asset classes and managers all the way down to the security level. One of the guiding principles of a sound investment strategy is diversification. And our team of experts uses this to create tailored, strategic allocations for our clients. To illustrate its importance over time, let's walk through a simple case study. Take a look at this rank-ordered list of asset class performance for each of the last 10 calendar years. What you'll notice is that it's rare to see an asset class consistently near the top or the bottom. Each asset class's position in this list jumps around from year to year. That means you're going to see winners and losers in any portfolio every year. And we all have to fight the temptation to chase the winners or abandon the losers. Why is this important? Well, let's consider three investors with three different approaches. One being a return chaser who invests all of their money in last year's best performing asset class, a contrarian who invests all of their money in last year's worst performing asset class, and lastly, the diversifier, who simply holds an equal weight to each and every asset class on the list. If we let these strategies play out, you can see that the return chaser wins half the time. The contrarian wins 3 out of 10 times, and the diversifier has only won twice. So 80% of the time, the diversifier is losing out to the other two strategies. It reminds me of a discussion we've seen going around the financial media recently, this notion that diversification will always disappoint. And believe it or not, it's a discussion in support of diversification. It's basically about how, with the benefit of hindsight, there will always be a concentrated portfolio that outperforms the diversified portfolio. There will always be something. And it's tempting to think that we could have or should have seen it coming. In the investment world, we call this feeling hindsight bias. As the saying goes, hindsight is 20/20. Our mind plays tricks on us. We attribute some of the certainty that we gain after the fact retroactively to the past, leading to this false sense of how easy it is to predict the future. Well, it's not easy, and again, we need to fight the temptation to chase returns because the temptation will always be there. But let's not be deceived by the diversifier trailing in 8 out of the 10 years. That's not the whole story. If we look at the whole 10-year experience instead of year by year, you can see that the patience and discipline of the diversifier are rewarded. The return chaser and contrarian had essentially no return, with risk well into the 20s and 30s. That's higher than the risk that we would normally associate with equities. The diversifier, on the other hand, earned a modest return and had less than half the risk of the other two. And that's exactly what we'd expect to see from a diversified approach. A good return with a lot less risk. It's not flashy. Diversification is not the sports car. It's the family cruiser with the good gas mileage and the great safety features. But that's what we want, a strong path to long-term success. We all just need to recognize the importance of a strategic long-term view and have the patience and discipline to stick with it. Here are a few things to remember. A concentrated portfolio can outperform in the short term, but diversification is the key to long-term success. Don't overreact. Avoid chasing the winners and abandoning the recent losers. Hindsight bias is the enemy of discipline and long-term success. We are focused on achieving your goals. We create diversified strategic allocations with skilled managers, and we actively manage your exposures responsibly within a risk management framework. For more information, please visit us at www.seic.com.